This one characteristic makes or breaks a good long-term investment in a business. Among the 8 types of competitive advantages, economies of scale, brand power, network effects, patents, switching costs, regulatory advantages, pricing power, and high initial cost to start, Warren Buffett has repeatedly highlighted one as supreme: pricing power. In his words, the single most important decision in evaluating a business is pricing power. If you've got the power to raise prices without losing customers to a competitor, you've got a very good business. Charlie Munger reinforced the same point from a different angle. The best businesses are those that can raise prices easily and don't need much capital to grow. They pour cash into your pockets. And Chris Hohn, one of the most influential value investors of the past 2 decades, explained why pricing power matters so deeply in today's markets. Businesses that can raise prices ahead of inflation are the only true inflation hedge. They protect real returns for shareholders. Now I will deep dive into the topic of what pricing power is, why it is the rarest and most valuable mode, and how even tiny price increases can produce massive long-term earning gains. Pricing power is the ability of a business to raise the price of its goods or services without losing customers and without weakening demand. It demonstrates customer loyalty, brand strength, product indispensability while building competitive barriers. A company with pricing power has several quite powerful abilities: to offset inflation, to expand profit margins. It can grow earnings faster than revenue, compounds intrinsic value with minimal capital, avoids destructive price wars. It is the opposite of a commodity business where companies must sell at whatever price the market dictates. Commodity-based businesses are not good compounders as their earnings are determined by factors out of their control. Buffett summarized it perfectly. If you need to hold a prayer session before raising prices by 10%, you've got a terrible business. Let me explain the mathematics of pricing power. The financial impact of pricing power is wildly underestimated. Consider a company with a 20% profit margin. Consider no change in unit volume, meaning they sell the same amount of service or goods. And consider a 1% price increase above inflation. Even such a tiny increase can produce disproportionate profit growth over time. Why and how a 1% price increase equals 5% earnings increase? Suppose a business has $100 in revenue and $20 in profits, which gives it the 20% profit margin. A 1% price increase raises revenues to $101, but costs remain roughly the same because inflation is absent in our example. This gives the company a new net profit of $21, as all the price increase goes to the bottom line due to no increases in costs. Then the profit increase equals 5%. $1 increase compared to $20 in earnings equals to 5%. This happens because price increases flow almost entirely to the bottom line. A 1% revenue increase becomes a 5% earnings increase. With lower margins, say 5% or 15%, the effect is even more dramatic, often creating 7% to 12% earnings growth from a single 1% price action. This is why Chris Hohn tells investors that pricing power is the only reliable inflation hedge and the fastest driver of earnings growth. Another practical example is the toll bridge model. Buffett often compares pricing power to owning a toll bridge. You build the bridge and charge whatever the traffic will bear. Imagine a toll bridge that charges $1 per crossing and earns a 50% margin. Raising the toll to $1.05 increases profits to 10%, as 5 cents is 10% out of 50 cents, which were the previous earnings before the price increase. But why is it so powerful? Almost all the extra 5 cents is pure profit. The cost of letting another car pass over the bridge is near zero. This simple example reveals why asset-light businesses with strong competitive positions can compound capital at enormous rates. In order to find such businesses, you must know they achieve pricing power. Pricing power does not appear by accident. It arises from other moats. The moats of a business give it structural advantages that competitors cannot easily replicate. A company may have some of these other competitive moats, but it may not possess a true pricing power. The 8 different types of moats can stack on each other so that a business can have an even bigger chance of success, but those companies are very rare to find. The most common moats which build to a potential pricing power mechanism are: 1. Strong brands. Consumers trust the brand and are willing to pay more for it. Examples: Apple raises iPhone prices almost annually without reducing unit sales. Nike sells a $3 shoe for $150 because of brand equity. Coca-Cola, a few cents more per can, multiplied across billions of servings equals billions in profit. LVMH, luxury goods with identity-driven demand. 2. Network effects. The product becomes more valuable as more people use it. Examples: Visa and MasterCard Merchants cannot ignore them. Cardholders have no alternative. Meta's and Google's advertising platform. Businesses need access to the network of users. 3. High switching costs. Customers face friction, costs, headaches, risks when switching providers. Examples: Microsoft Office, replacing it disrupts workflows for millions. Adobe Creative Cloud, industry standard, switching is costly for professionals. Salesforce CRM, very big headache if a company has to switch its database and CRM. 4. Regulatory moats. Government restrictions limit competition. Examples: Moody's and S&P ratings oligopoly with high barriers. Utilities, companies in the electricity, gas and pipes business. They often have geographic monopolies granted by regulation. 5. Intellectual property. Unique features allow premium pricing, but they are protected in the long term via a patent or some unique and hidden technological advantage or far more advanced technological advantage. Examples: Tesla. Software, charging network, brand differentiation. TSMC, a unique technological advancement, have made them the leading company in the computer and AI revolution. The other two modes, high initial cost of capital and economies of scale, are less likely to lead to a pricing power effect, but there are exceptions to this. I have a free list of 30 companies categorized via their mode status. Grab the document for free. I placed it in the description of the video and the pinned comment. Everyone should understand that pricing power is more valuable than growth alone. Growth without pricing power is often value destructive. Many companies grow revenue by cutting prices, spending heavily on marketing, or burning capital. Munger warns, some businesses grow rapidly but destroy value because they require every dollar of capital just to stand still. The rule of thumb here is to not have a very capital-intensive business. If the business needs a lot of CAPEX spending, which stands for capital expenditures in the long run, these types of business will not have the most optimal return. We want a low CAPEX, high-earning company with pricing power and a long runway for growth. Pricing power, on the other hand, expands earnings without expanding capital, requires minimal reinvestment, creates self-reinforcing compounding, provides resilience in inflationary periods, protects cash flow in recessions. A company that can raise prices even when the economy weakens has a moat stronger than any patent. Some of the many real-world pricing power champions are Visa and MasterCard. They raise per transaction fee steadily because their payment networks are indispensable. Another champion is Moody's. Charges more over time because issuers cannot avoid ratings from recognized agencies. In all these cases, pricing power, not revenue growth alone, drives sustainable compounding. Meta is another great example. It obviously has a major networking effect, and advertisers in the world are at the mercy of Mark Zuckerberg's price change decisions. Pricing power is the most valuable competitive advantage because it allows a company to raise prices above inflation and convert nearly every additional dollar into incremental profit. Its simple but profound mathematics explains why Buffett, Munger, and Chris Hohn emphasize pricing power more than any other mode. A company that can raise prices without fear of customer attrition is not merely protected, it is destined to compound intrinsic value year after year. In a world of inflation, competition, and technological disruption, pricing power remains the clear signal of a wonderful business. I have also prepared for you a free Warren Buffett-style fundamental metrics cheat sheet. You can grab it via the link down in the description or check the pinned comment in the comments section. The 30-mode company watch list is also there. Subscribe for more and leave a comment. I read all of them.